Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be doing a deep dive into Beyond Meat and exploring some red flags in the company. Beyond Meat, stock ticker symbol BYND, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Just before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. The channel is growing, which really means a lot. Thank you for your continued support. Now let's go ahead and jump in. Cue the logo. Let's review a bit about Beyond Meat. Beyond Meat is one of the most popular plant-based food companies but has failed to mature into a profitable business. After going public via an IPO in 2019, the share price initially rose quickly only to fall months later. At its peak Beyond Meat traded for nearly $235 in July 2019, when it had no earnings. More recently, the share price has fell to an all-time low of $5.58 in October and has since rebounded to above $8 at the time of this video production. Altogether, Beyond Meat has lost 88% since its IPO, representing a -36% CAGR. Beyond the dismal price action, there is some real trouble brewing beneath the hood. When we come over here to market share and type in the ticker symbol for Beyond Meat, we see some devastating results. The current market share for the plant-based food company is 0.04% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This by itself is not a big deal. Beyond Meat is a tiny company with huge growth prospects, right? Well, the data tells a different story. This tiny market share has also been shrinking. The 5-year market share CAGR for Beyond Meat is -3%. This tiny company is losing precious market share every year. If we start in 2019, we see that the market share was 0.04%, 0.06% in 2020 and 2021, fell to 0.05% in 2022, and fell further to 0.04% over the trailing 12 months. While customers were willing to spend money for Beyond Meat products in 2020, since then customers have clearly lost interest. In this newest version of market share, we can actually perform a sub-analysis among a basket of selected companies. A primary goal of Beyond Meat was to pry customers away from eating meat and eating their plant-based products as an alternative. Not that Beyond Meat planned to totally replace meat, but it was thought that the company could pull bits of market share away from meat producers. Well, things have not gone according to plan. When we compare Beyond Meat to a meat producer like Tyson Foods, the results are not good. Out of those two companies, Beyond Meat holds a 0.66% share of the market. But what is really important is that Beyond Meat is actually losing market share to Tyson Foods given the -1% CAGR. Now, this does not necessarily mean that former Beyond Meat customers are now buying Tyson products instead, but between the two companies, customers are choosing to spend less and less on Beyond Meat. Sure, but what about vegan and vegetarian Beyond Meat customers, you might ask? Surely they still like Beyond Meat products. Well, this is where it gets really sad. When we compare Beyond Meat against Oatly and Laird Superfood, two of the most popular publicly traded plant-based companies, the results actually get worse. Out of those three companies, Beyond Meat currently has a market share of around 30%. However, Beyond Meat is losing 15% of its share of that plant-based basket every year. I interpret this to mean that vegan and vegetarian customers, the cornerstone of Beyond Meat's business, spent less and less of their food money on Beyond Meat's products every year. And they are not buying meat, they are just choosing other products instead. For a small and profitable company like Beyond Meat, market share growth is a very important factor. Unfortunately, demand for Beyond Meat's products has evaporated. But do they have time to fix the problems? Looking at this chart of cash and free cash flow, or, in Beyond Meat's case, cash burned by the business, we see that Beyond Meat raised some cash in 2021 and has been slowly decreasing cash burn since that time. For the trailing 12 months the company had $218 million in cash with a $151 million cash burn. At this rate Beyond Meat has over 1 year of operating runway. During that year, shareholders are hoping that potential interest rate cuts will help the business. A recent Motley Fool article shares the following perspective. Inflation has been slowing in the country and there is the possibility that there could be at least one rate cut in 2024. It's by no means a guarantee, but with a potential recession taking place in 2024, there's a chance that interest rates could finally start coming down. For a company such as Beyond Meat, which incurs losses and burns through cash, a lower interest rate makes it easier for the business to grow, because it can take out loans at a lower rate. And when interest rates decline, that means investors get lower returns from safer options, such as holding money at a bank. That can lead to more money flowing back into the stock market, which, in turn, can also result in more people buying up shares of Beyond Meat. I have a somewhat different take. While a potential recession would likely result in interest rate cuts, recessions themselves are bad for business and would likely outweigh any potential benefit for the company to borrow more cheaply. If we look at a chart of interest income and cash, we see that as cash has been declining, interest income has been rising. This is likely due to the rise in interest rates, which based off the trailing 12-month data sits around 4.9% for the company. So Beyond Meat is generating $10.7 million just from its cash sitting passively. On the other end of the spectrum, the trailing 12-month interest expense and total debt tell us that Beyond Meat is paying 0.3% interest on its debt. This indicates a tremendous arbitrage of at least 4.6% for the company. When we look at a chart of interest income and interest expense, the trailing 12 months show that the company generates nearly 3 times more in interest income than it pays in interest expense. This is likely because Beyond Meat's debt was largely financed before interest rates rose to around 5%. So Beyond Meat has actually been benefiting from high rates, and any reduction in interest rates will diminish this advantage. All in all, I am pretty pessimistic about Beyond Meat in 2024. Market share is declining rapidly, cash continues to burn, and a recession may be around the corner with corresponding interest rate cuts, all of which are very, very bad for Beyond Meat's business. While the fearless among us can certainly trade this company profitably, I think it has very bad fundamentals for long-term investing. Let's hope this gets fixed in the next year before the cash runs out. Many thanks for watching. What do you think about Beyond Meat and their shrinking market share? Did you like this type of video? It is a departure from our typical video format, so please share your thoughts below. Please check out some more videos right now and don't forget to put your money where your mouth is.